Hello, and a massive welcome back to the Handsome Trader channel. I'm absolutely delighted to have you here with us today.
It's great to be here.
Whether you are tuning in from, the bustling streets of New York, the historic centers of Europe, or anywhere else on this beautiful planet, we are gathered here for one specific reason. Our mission on this channel is to strip away the confusion of the financial world. We want to help you understand the markets in a way that is slow, clear, incredibly easy to understand, and above all, practical for your daily life.
That's the key word, isn't it? Practical.
It is. We know trading can feel like trying to drink from a fire hose, and, well, our job is to turn that chaos into a calm, steady stream.
That is a beautiful way to put it. It is a pleasure to be back.
Now, before we really get our hands dirty with today's material, I have a request for everyone listening. We put a lot of work into these deep dives, and we do it for you.
We really do.
So if you find value in what we discussed today, if you have a aha moment, please smash that like button. Share this deep dive with a friend who might be struggling with their charts. And please subscribe to the channel to support the show with all your sincere heart.
It genuinely helps us keep the lights on and the content coming. It really does. The community support is what drives this whole project.
Absolutely. Now, today's topic is, well, it's the elephant in the room. It's the thing everyone whispers about, but, rarely confronts directly. We are looking at a profound, almost uncomfortable truth. Why is it that 95% of traders find this profession impossible? Why do they blow up accounts, lose their savings, and quit in frustration?
And on the other side of that.
Exactly. Meanwhile, there is this tiny elite group, the 5%, who find it obvious, not just profitable, but almost easy.
It's the statistic that haunts everyone who opens a brokerage account.
Yeah.
You see the warning labels, you hear the stories, but you always think, I'm going to be different.
I'm the exception, of course. And to help us unpack this mystery, I am thrilled to introduce our expert guest. For those who don't know, he's a veteran American trader who has survived decades in the markets. He specializes not just in technical analysis, but in trading psychology.
The messy stuff.
The messy stuff, exactly.
Yeah.
Fixing the mental roadblocks that keep us poor. So a huge welcome to the deep dive.
Thank you so much. I'm really looking forward to this. When we talk about that 95% failure rate, people usually assume the solution is it's more secrets.
Right.
They think the 5% have a hidden algorithm or inside information or faster computers.
Right. We assume the game is rigged, that someone else has an unfair advantage.
We do. But today, I want to talk to the listener who is feeling the pain of the 95% right now.
Yeah.
I'm talking to the person who just blew an account last week.
Who's feeling that sting?
The person who feels like the market is personally attacking them. My thesis for today is simple, but well, it can be controversial. The difference between the winners and the losers is not intelligence, it isn't capital, it isn't even information.
Okay.
It is a fundamental shift in how they view the game. The 95% are fighting a war, the 5% are playing a game they have already won.
That is a hook if I've ever heard one. Fighting a war versus playing a game you've already won.
Right. I have to challenge you on that, though.
Please.
Because intelligence seems like it should matter. Trading is complex math, right? It's probability, it's economics. Surely smart people do better.
You would think so, wouldn't you? It makes logical sense. In every other field, medicine, engineering, law, intelligence is the primary predictor of success. You have a high IQ, you make a great surgeon.
Right.
But in trading, intelligence can actually be a liability.
A liability. So being smart is a disadvantage. How does that work? It can be. And to illustrate this, I want to tell you a story about two traders. Let's call them David and Sarah. This isn't hypothetical. These are archetypes based on hundreds of traders I've worked with over the years.
Okay.
Let's start with David.
Okay, introduce us to David.
David is the guy your parents wanted you to marry. He's a brilliant software engineer. He has a master's degree. He solves complex logic problems for fun.
Oh, one of those guys.
One of those guys.
Right.
He's disciplined, hardworking, and incredibly successful in his corporate career. So when David decided to get into trading, he treated it like an engineering problem.
Which makes perfect sense coming from his background. He thought, I can solve this.
Exactly. He thought, the market is just data. If I can analyze enough data, I can find the pattern and predict the outcome. So David built a command center. I'm talking about 4 monitors, vertical screens, the whole 9 yards.
The classic trader setup you see in movies.
The absolute stereotype.
Yeah.
And his charts. Well, they were something to behold.
I can only imagine. What did they look like?
It looked like a Christmas tree designed by someone having a nervous breakdown.
Okay.
He didn't just have a price chart. Oh, no. He had the RSI, the Mishi-D, Bollinger Bands, Ichimoku clouds, stochastics, volume profiles, and Fibonacci retracements, all on the same screen.
Wait, hold on. The Ichimoku cloud alone can take up half the chart. How can you even see the price candles with all those lines?
I can't. That's the point.
Yeah.
The price was buried under layers of geometry. But to David, this felt like safety.
Safety? How so?
He believed that every indicator gave him a little more of an edge. He thought, if the RSI says buy and the Mishi-D is crossing up and we're bouncing off the lower Bollinger Band, then it must go up.
He was trying to get confirmation to filter out the risk with data?
Precisely. He was looking for a guarantee in a world where there are no guarantees. And his routine, it was brutal.
Oh, I bet.
He would wake up at 4:30 in the morning. He'd spend 3 hours reading economic reports, checking Asian market sentiment, reading tweets from hedge fund managers, and analyzing the yield curve. He worked harder at trading than anyone I know.
Okay, so he's smart, he's got the tools, and he's outworking everyone. In any other job, David is the CEO. What happened to him in the markets?
Total destruction.
Wow.
In 18 months, David blew through 4 separate trading accounts. He lost a total of $65,000.
Ouch. $65,000? That is life-changing money for most people.
It is. And the psychological toll was even worse. He didn't just lose money, he lost his confidence. His whole identity was built on being the smart guy who solves problems. And here was a problem he couldn't solve.
So what did he do?
He started believing the market was rigged against him specifically. He thought algorithms were hunting his stop losses.
The classic narrative.
The classic narrative. He walked away bitter, angry, and convinced that trading is a scam.
It's tragic because he did everything right according to societal standards. He studied, he worked hard.
He did. He just applied the rules of one game to a completely different game.
Okay, now, contrast this with Sarah. Who is Sarah?
Sarah is the complete opposite of David. She didn't go to college. She doesn't know what a yield curve is. She probably thinks Fibonacci is an Italian cheese.
Okay.
She can't write a line of code. Before trading, she spent 10 years working as a dealer in a casino.
A casino dealer. Okay, that is an interesting pivot. From blackjack to the stock market.
It's the perfect pivot. Because standing behind that blackjack table night after night, Sarah learned something David never did.
What was that?
She watched thousands of people gamble. She saw smart people, dumb people, rich people, poor people. And she saw that the house at the casino always won in the end.
Because the house cheats? Is that what she learned?
No, not at all. That's the common misconception. The house doesn't need to cheat. The house wins because it has a small statistical edge, and this is the key part, they execute it without emotion over thousands of hands. The pit boss doesn't cry when a player hits a hot streak and wins a big hand. They don't get excited when the player loses it all back. They just deal the cards. They follow the rules. It's just a process.
So she brought that house mindset to trading.
She did. Sarah's trading strategy was shockingly simple. It was almost embarrassingly simple. She didn't have 47 indicators. She had maybe one moving average just to see the general trend.
Just one?
Just one. And she had 3 rules. That's it. 3.
Okay, what were they?
Rule 1, trade only during specific hours, a 2-hour window when her particular setup tended to appear. Rule 2, risk exactly 1% of her account per trade, no more and no less. Win or lose, the risk was identical every time.
Okay.
And rule 3, exit at a predetermined level. She knew her target and her stop loss before she even clicked the button.
That's it. No checking the news. No Bloomberg terminal.
No. She viewed the news as noise. She viewed the market as a giant digital casino, a stream of probabilities. She didn't try to predict what would happen next.
She just reacted.
She just reacted to what was happening. Based on her simple rules, she was the house.
And the result for Sarah?
In the same 18-month period where David lost $65,000, Sarah was up 42%.
Wow.
She wasn't getting rich overnight. There were no 1,000% gains. But she was consistently, boringly profitable.
Boringly profitable. I love that phrase. But this brings up a huge contradiction. If Sarah's way works, if simplicity is the key, why do we all instinctively act like David? Why does our brain want to add the 47 indicators? Why is it so hard to just be simple?
That is the million-dollar question, isn't it?
Yeah.
And the answer lies in our biology. Trading, when you really look at it, effectively breaks the human brain.
Breaks the brain.
It violates almost every rule of survival and success that we have learned over thousands of years of evolution. We are wired for a world that operates on clear cause and effect, and the market is a world of pure chaos and probability.
Okay, let's dig into this. You've identified 5 obstacles, 5 specific ways our brains sabotage us. I think a lot of listeners are going to recognize themselves here. What is the first obstacle?
The first, and perhaps the biggest, is the uncertainty paradox.
The uncertainty paradox.
Yeah.
Okay.
Think about your life or David's life as an engineer. Humans crave certainty. We love patterns. We need to know what's coming next. In a normal job, there is a linear relationship between effort and reward. You show up at 9, you do the tasks you're supposed to do, you leave at 5, and you get a paycheck 2 weeks later. It's predictable.
Right. Effort equals result. If I study for the exam, I get an A. If I build the bridge correctly, it doesn't fall down.
Exactly. We are trained from birth to believe that if we do things right, we will be rewarded. But the market has zero structure. It is a place of pure, unadulterated uncertainty.
So you can do everything right.
You can do everything right, follow your plan, manage your risk, enter perfectly, and still lose money.
That feels unfair. It feels like a violation of a fundamental contract with the world.
It feels like an injustice.
Yeah.
And conversely, you can do everything wrong. Risk 50% of your account on a dumb hunch, break every rule in the book, and make a fortune on a lucky trade.
Right.
The link between good process and good outcome is severed in the short term.
So how does our brain react to this lack of structure?
Panic. The brain hates uncertainty. It views uncertainty as a threat to survival. So, like David, we try to manufacture certainty where none exists.
And that's where the indicators come in.
That's where they come in. We layer on the indicators. We read more news. We tell ourselves, if I just check the 4-hour chart and the daily chart and the weekly chart, I will know for sure. We are trying to grab smoke with our bare hands.
We're trying to turn a probability game into a certainty game, and that's impossible.
It is impossible, but the illusion of control is so seductive. And that leads us directly into the second obstacle, which is the instant feedback loop.
I have a feeling I know what this is. This is the pain of losing money, right?
It's more than just pain. It's biology. In most areas of life, feedback is delayed. If you eat a cheeseburger today, you don't instantly have a heart attack.
Right.
If you go to the gym today, you don't instantly have abs. There's a buffer. There's time between action and consequence.
True. But in trading,
you click buy, and within 3 seconds, you see red. You're losing money. The feedback is immediate. And here is where the lizard brain, the amygdala, the most primitive part of our brain, kicks in.
okay.
To your primitive brain, losing money feels exactly the same as being chased by a tiger.
Wait, really? The brain can't tell the difference between a falling stock price and an actual physical threat?
Not on an emotional biochemical level.
Yeah.
The fight or flight response is identical. Your heart rate spikes. Cortisol floods your system. Your palms sweat. Your vision narrows. You stop thinking logically and start reacting instinctively.
And when we are in fight or flight, we make terrible trading decisions.
The absolute worst. We move the stop loss further away because we don't want to accept the pain of the loss. That's the flight response, trying to avoid the threat. Or we revenge trade. We double our size to win it back immediately. That's the fight response, attacking the threat.
I've definitely been there. You take a loss and you immediately want to punch the market back. You click buy again, just out of pure anger.
That is the feedback loop in action.
Yeah.
The 95% are trapped in this biological reaction. They're trading their emotions, not the chart. Sarah, the casino dealer, didn't have this problem.
Why not?
Because she knew that one bad hand didn't mean the tiger was eating her. It just meant she lost a hand. The next hand was coming.
So she desensitized herself to the outcome of any single event. Okay, so we have the fear of uncertainty and the pain of immediate feedback. What is the third obstacle? This one sounds like something smart people like David suffer from specifically.
It is. Obstacle number 3 is complexity addiction.
Addiction, that's a strong word.
It is an addiction. We've been conditioned our whole lives to believe that complexity equals value. If a solution is simple, we don't trust it. We think it's too good to be true.
Can you give me an example?
Imagine you go to a doctor because you have a headache. If he looks at you and says, drink more water and get more sleep, you feel cheated.
Right. I paid for that.
Exactly. You think, I paid you for expertise. Give me a complex diagnosis. But if he runs an MRI, gives you a pill with a long Latin name, and explains the intricate neurochemistry of your brain, you feel satisfied.
Even if the cure is still just water and sleep?
Even then, we equate complexity with thoroughness and value.
That is so true. We undervalue the simple solution.
In trading, this manifests as overanalysis. Traders feel that if a strategy is simple, like Sarah's 3 rules, it can't possibly work against the mighty Goldman Sachs algorithms. They think, I need to be as complex as the market.
But isn't there some truth to that? I mean, the market is complex. Shouldn't our analysis be deep?
Deep, yes. Complex, no. There is a critical difference. Deep means understanding the core principles. Complex means adding unnecessary layers.
Okay.
Complexity in execution creates confusion. When you have 47 indicators, like David, you will always find a reason to buy and a reason to sell at the exact same time. One says up, one says down.
You end up with analysis paralysis.
You freeze. You can't make a decision. Or worse, you engage in what I call false productivity.
What's that?
You spend hours watching YouTube videos, reading books, tweaking the settings on your indicators. It feels like work. It feels like you are being a responsible trader.
But you're not actually trading.
You're not. You are just consuming information to hide from the fear of actually clicking the button and facing uncertainty.
Consumption disguised as preparation. I think that is going to hit a lot of our listeners hard. It's so easy to feel productive when you're just watching videos.
It's the ultimate form of procrastination for a trader.
Let's move to obstacle number 4. This one seems to be about how we judge ourselves.
Yes. Outcome obsession. This is the error of judging the quality of a decision based solely on its result. In the world of poker, they call this resulting.
Explain that concept.
Okay, let's use an extreme example. Let's say you get drunk, blindfold yourself, run across a 6-lane highway during rush hour, and somehow you make it to the other side safely. Was that a good decision?
Absolutely not. It was reckless and incredibly stupid.
Right. The process was terrible. But if you were outcome obsessed, you say, I made it to the other side, therefore I am a genius at crossing roads. In trading, people take terrible high-risk trades, get lucky, make a bunch of money, and think they're skilled.
And the reverse is also true.
Exactly. And this is the more dangerous side. You can make a perfect, disciplined, low-risk trade that fits your plan and lose money because of some random news event you couldn't control. The outcome-obsessed trader beats himself up. He says, I was wrong, I'm stupid, my strategy is broken. And what does he do?
He changes the strategy.
He changes his strategy because of one bad outcome. That is a recipe for insanity. You're constantly changing your rules based on random luck.
It creates an emotional roller coaster. You feel like a god when you win and a total failure when you lose. You cannot survive a career like that.
You can't. You have to detach from the outcome of any single trade.
Which leads us to the final obstacle, number 5. This feels like a very modern problem.
It is the defining plague of our era, information overload. David thought that having more information gave him an edge. He was reading everything. But in the financial markets, information is not a scarce resource. It's an overabundant one. There was too much of it.
And a lot of it is conflicting.
Always. Turn on any financial news channel. One guest says the market is crashing. The very next guest says we are in a new bull run. Check social media. One chart says buy, another chart says sell. If you try to integrate all of this conflicting data, you will go insane.
So more information actually creates less clarity.
Precisely. It's noise. Most financial news is just entertainment. It's designed to get clicks and generate ad revenue, not to help you trade profitably. By consuming it all, David wasn't becoming informed. He was becoming distracted. He was letting other people's opinions override his own plan.
So to recap the Breaking Brain, we hate uncertainty, we overreact to instant pain, we're addicted to complexity, we obsess over results, and we drown ourselves in noise.
That's the playbook for the 95%.
It's a wonder anyone makes money at all.
It really is. That's why it's only 5%. The default human setting is to fail at trading. To succeed, you have to manually override your factory settings.
Okay, so let's talk about that override. We know the poison. What is the antidote? How do we shift from the impossible world of David to the obvious world of Sarah? You've outlined 5 shifts. What is the first step we need to take?
The first shift is to embrace uncertainty. And I don't mean just tolerating it or putting up with it. I mean truly accepting it as the core nature of this business. And to do that, we have to stop using the language of prediction.
What does that sound like in practice?
Stop saying gold will go to 2,000. Stop saying the market has to bounce here. The market doesn't have to do anything. It has no obligation to you.
It can stay irrational longer than you can stay solvent, as the old saying goes.
Exactly. The 5% shift their language to the language of probability. They don't predict. They weigh the odds.
So instead of, this will go up, they say,
this setup has a 60% chance of working out. Or, if price breaks this key level, the odds favor a continued move up. It's a huge mental shift.
It sounds subtle, but it completely changes your expectations.
It changes everything. If you say it will go up and it goes down, your brain enters a state of shock. You freeze, you feel betrayed. But if you say it has a probability of going up and it goes down, you just say, oh, well, this was the 40% time.
No emotional reaction.
None. You accept the loss as a business expense and you move on. You stop trying to be a fortune teller and start being a risk manager.
I love that. Stop trying to be a fortune teller. Sarah didn't know the next card in the deck, but she bet anyway because she knew the odds were in her favor over the long run. Okay, shift number 2. This one tackles that outcome obsession we talked about.
Shift 2 is measure process, not outcomes. We need to completely redefine what a successful trading day means.
Most people would say a successful day is a day where my account balance went up. Pretty simple.
And that is wrong. That is the trap. A successful day is a day where you followed your rules 100%, full stop.
So if I lose $500, but I followed every single one of my rules to the letter.
That was a successful day. You should high-five yourself. You should go buy yourself a nice dinner. You did your job perfectly.
That is really hard to wrap your head around. Celebrating a financial loss.
You are not celebrating the loss. You are celebrating the discipline. Look, you cannot control what the market does. You can only control your own execution. If you judge yourself by the money, you are judging yourself on something you can't control. That leads to helplessness and frustration.
But if you judge yourself on your execution...
You are always in control. You are the master of your own destiny.
I recommend listeners actually write this down. Make a checklist for the end of your day. Did I wait for my setup? Yes. Did I size correctly? Yes. Did I stick to the plan without hesitation? Yes. If the boxes are checked, you win, regardless of the P&L.
Exactly. If you do that for 100 trades, I promise you, the probabilities will take care of the money.
Let's move to shift 3. This is the cure for that complexity addiction.
Shift 3 is simplify ruthlessly. And I'm going to give the listeners a direct challenge right now, or after this deep dive. I want you to look at your trading screen. If you look like David, if you have 5 indicators, 3 moving averages, and a news feed, I want you to delete 90% of it.
Oh, I can hear the panic in the audience right now.
Oh, but
I need my MACD. I need my RSI.
do you really? Or is it just a security blanket that's actually smothering you?
Yeah.
The challenge is to strip it all down to the absolute bare essentials. One strategy, one time frame. Simple, unambiguous rules. If price does A, then I do B.
Why does this work better under pressure?
Because under stress, your higher level cognitive function shuts down. It's that fight or flight response again.
Yeah.
Complexity is fragile. Simplicity is robust. When the market is crashing and volatility is spiking, you can't process complex algebra in your head. You need a big red button that says sell.
Right.
Sarah's strategy worked because she couldn't mess it up. It was too simple to fail her under pressure.
I heard a great quote once. Complexity is confusion with a fancy outfit. We often confuse sophisticated with effective. A hammer is simple, but it drives the nail every time.
Exactly. Be a hammer, not a Swiss Army knife with 100 tools you don't know how to use.
All right, shift number 4. How do we deal with all the noise, the information overload?
Shift 4 is practice strategic ignorance. This is about consciously and deliberately going on an information diet.
A diet.
Yes. Just like junk food makes your body sick and sluggish, junk information makes your trading sick and sluggish. You need to deliberately cut off sources of information that aren't core to your strategy.
So, unfollow the gurus on social media.
Unfollow the gurus. Turn off the financial TV. Stop reading the forums where everyone is arguing. Sarah didn't read the Wall Street Journal before her shift. She looked at her cards, which was the price action, and the dealer, which was the overall trend. That's it.
It sounds scary to cut yourself off like that. You feel like you'll miss something important.
What are you really missing? Opinions, guesses, fear-mongering. If a truly major event happens, like a central bank announcement, the price will move. The chart will tell you everything you need to know. If you are a technical trader, the price is the only truth. Everything else is just gossip.
So focus is the new currency. By ignoring the noise, you protect your focus.
Correct. You protect your mental capital, which is far more valuable than your financial capital.
And finally, shift number 5. This might be the hardest one for our modern adrenaline junkie brains.
It is. Develop patience as a strategy. We need to reframe the idea of doing nothing.
In our society, doing nothing is seen as laziness. You always have to be busy.
But in trading, doing nothing is an active position. It is often the most profitable position you can take. I want to introduce the concept of the sniper versus the machine gunner.
Okay, go on.
An amateur trader, the 95%er, is a machine gunner. They get to their screen and they start firing. They're running around, spraying bullets, which are trades everywhere, hoping to hit something. They waste ammo, they reveal their position, and they usually get taken out.
And the professional?
The professional is a sniper. They might lie in the mud, perfectly still for 3 days. They don't move, they barely breathe, they just wait. And wait for the one perfect shot. The target lines up, the wind is right, the conditions are perfect.
And then?
They take one shot. Bang. Profit. Then they pack up and go home.
That requires immense discipline to sit there for 3 days and do nothing, just observing.
It does. I knew a day trader. Let's call him Michael. He was a scalper, taking 20 to 30 trades a day. Just constant action. He was stressing himself out, paying a fortune in commissions, and basically breaking even.
A lot of work for nothing.
A ton of work. I told him, Michael, I'm going to give you a new rule. You are banned from trading more than 3 times a day, maximum of 3.
That must have killed him, to go from 30 trades to 3.
He hated it. For the first week, he was miserable. He felt bored. He felt useless. But do you know what happened? He stopped taking the garbage trades. He couldn't afford to. He had to be picky. He had to wait for the obvious setups because he couldn't waste his bullets.
And the result?
His win rate went from 42% to 61% in 1 month.
He did less work and made significantly more money.
That is the ultimate goal of professional trading. But you have to embrace the boredom to get there.
And that leads us to the final piece of the puzzle, this deeper level. You mentioned an identity shift. This goes beyond just tactics and rules.
It does. All these shifts we talked about, simplifying, waiting, ignoring the news, they culminate in a new identity. You have to stop seeing yourself as a profit chaser.
But isn't that what we're here for? To chase profit?
No. If you chase profit, it runs away from you. You need to start seeing yourself as a rule executor.
A rule executor.
Your job is not to make money. That's not your job description. Your job is to execute a set of rules flawlessly. The money is just a byproduct of doing that job well over a large sample size of trades.
That's a subtle shift in perspective, but it takes all the pressure off of any single trade.
It makes you psychologically bulletproof. If you execute your rules perfectly and lose money, you didn't fail. You did your job perfectly. The market just didn't cooperate on that specific instance. And this brings us to what I call the boring truth.
The boring truth.
Real trading professional profitable to trading is boring. It is mundane. It is repetitive.
It's not the Wolf of Wall Street, no fast cars and screaming on the trading floor.
No midget tossing, no screaming.
Yeah.
It's quiet. It's just you and a screen. Wait, click, execute. Wait, repeat.
You've compared it to brushing your teeth earlier?
I did. Do you get excited when you brush your teeth? Do you high-five your wife after you floss?
No, of course not.
No. You just do it. It's routine. It's necessary hygiene. Trading should be the same. If your heart is racing and you're feeling a rush, you are gambling. If you are bored, you are probably trading well.
Boredom is the price of wealth. I think that needs to be on a t-shirt.
It's the absolute truth. The 95% want entertainment and excitement from the market. The 5% just want profit, and they accept boredom as the price of admission to get it.
So let's wrap up our story. What happened to David and Sarah in the long run?
David. Well, David is a tragic story. He went back to engineering, but he didn't just quit. He quit with a victim mentality. He tells everyone that the market is a scam, that it's all manipulated by high-frequency algorithms.
He blames everything but himself.
He never looked in the mirror. He never realized that he and his approach were the problem. He was fighting the wrong war.
And Sarah?
Sarah's still trading. She's not famous. She doesn't have a YouTube channel or sell a course. She just sits at her computer for 2 hours a day, follows her 3 simple rules, makes her money, and then goes and lives her life.
She won.
She won because she stopped asking, how do I predict the future? And started asking, did I follow my rules today?
And that made all the difference.
That is the only difference that matters.
This has been an incredible deep dive. We've gone from the chaos of the broken brain to the clarity of the obvious. Let's do a quick recap for the listeners who want to take action today. The 5 shifts.
Absolutely. Number 1, stop predicting. Start using the language of probability.
Number 2.
Focus on process. Grade yourself on following your rules, not on how much money you made or lost.
3.
Simplify. Delete the indicators and noise you don't need from your charts. Get ruthless.
Number 4.
Ignore the noise. Put yourself on a strict information diet. Protect your focus.
And the hardest one. Number 5.
Be patient. Be the sniper, not the machine gunner. Remember that doing nothing is a profitable action.
Simple steps, but they require a tremendous amount of courage to implement.
They require you to fight your own human nature, but the reward on the other side is freedom.
Friends, traders, listeners, thank you so much for spending this hour with us. We know your time is valuable, and we sincerely hope this conversation helps you stop fighting the war and start playing the game you can actually win. If this episode gave you even one nugget of insight, please smash that like button, share it with a trading buddy who is currently staring at a Christmas tree chart. And please subscribe to Handsome Trader to support the show with all your sincere heart. We appreciate you more than you know.
Thank you, everyone. And remember, keep it simple.
Now, before we sign off, we have to handle the legalities. Please listen closely to the following disclaimer. The tone is going to shift here for a moment.
The content in this video is for sharing knowledge and personal experience only. It is not investment advice.
Financial investment always involves risk. Viewers need to do their own research and take responsibility for their own decisions.
Never trade with money you cannot afford to lose.
Thank you so much for that. And thank you all for listening. We will see you in the next deep dive.
Goodbye and good trading.
Bye for now.